Well, first of all, the debt ceiling was not the crisis. That was a contrived crisis. The real crisis was for the politicians who wanted to run up more debt. And the debt ceiling limited their ability to do that. The crisis was, if we can't raise the debt ceiling, we have to come clean with the American public. We have to admit that we can't provide all the benefits that we promised. And that would have been very difficult for a lot of politicians because they may not have gotten reelected. So they solved the crisis by raising the debt ceiling. But that allows the real crisis to remain, which is the debt itself. Nobody seems to be caring about that. During the debates before they raised the debt ceiling, a lot of people talk about how bad it would be for American families if we didn't raise the debt ceiling, and it would mean that rates would be higher, that people would be paying higher interest rates. Well, people are going to pay higher interest rates because of the debt. In fact, they're going to have to pay higher taxes to repay the debt. That is the burden on the families. It's the debt itself. The limit tries to limit that burden, but the government wants the burden to be unlimited. They want to continue to pile on more debt that American families are obligated to repay, either honestly through higher taxes or dishonestly through higher prices, because they end up creating inflation to monetize the debt. Well, first of all, when you're comparing us to Japan, Japan is the exception. Japan is unique in how much debt to GDP it has. The United States is, one of the highest debt to GDP nations in the world. And most countries that have a debt to GDP anywhere close to ours are having a lot of trouble right now. To say that, well, Japan got away with it, we can too, is not an argument that I buy, especially if you look at the differences between Japan and the United States. Japan is a nation of savers, right? The individual Japanese can, in theory at least, afford this debt. The Japanese government bonds are almost owned exclusively by the Japanese. The Japanese don't depend on the rest of the world to finance that debt. But that doesn't mean it's not a problem. Look at what's happening in Japan right now. Inflation has finally broken out. It's at a 30 or 40-year high, yet they can't let rates go up because they have so much debt. So Japan is going to have a debt crisis of its own. They're going to have a price to pay. And it's very unfortunate for the Japanese because this is not going to be a low price. But if you also look at the aggregate of debt, you can't just look at the bonds, right? That's just one portion of a nation's debt. There are other obligations that governments are on the hook for, the money they actually borrowed. For example, the U.S. government has guaranteed all the bank accounts, it's guaranteed all the pensions, it's guaranteed student loans, it's guaranteed pensions of retired government employees, including the military. It has all of these commitments that are out there. And these unfunded liabilities dwarf the funded portion of the debt. You're talking about, let's say, $200 trillion worth of commitments that the U.S. government has made. And if you compare all of the unfunded liabilities that the U.S. government is on the hook for compared to Japan, we're in more debt. And also, look at our trade deficits. Japan does not have the enormous trade deficits that the United States has. So we've got another trillion plus per year that we have to borrow as a nation to maintain our standard of living. The Japanese don't have that problem. They have a budget deficit, but they don't have a trade deficit. We have both. And so you have to look at the totality upon which the U.S. depends on debt, and more importantly, the financing of that debt externally. And so I think we are much closer to an even bigger crisis than Japan. Inflation is over 5% at a minimum. And so if you're going to hold dollars, you're losing 5% of your value per year at a minimum. And so you need to be paid 5% just to, break even, to offset that decline in purchasing power. You need more dollars to have the same purchasing power. So in order to get people to hold dollars, they have to be compensated for that loss of purchasing power. But, I don't think 5% is going to be enough, because I don't think inflation is going to stay at that level. I think it's going to be higher. Plus, people don't loan money to break even. What's the point of loaning money if at the end of the day, you're just going to break even? You need a positive return that exceeds the rate of taxes by an amount that's high enough to make the loan worthwhile. The more a country borrows, the higher the risk that we might default. Look, we just spent several months telling our creditors, we're not even sure if we're going to pay you back. We may not raise this debt ceiling. If I'm a creditor of the United States, why do I want to take that chance to break even? Best case scenario, you keep raising the debt ceiling and I break even with this. Why? But the other problem is the more debt the US government has, the more likely they are to resort to inflation, printing money to pay it off rather than taxation. If inflation is going to be much higher, that means my losses are going to be much greater. So, why bother? So rates have to go up. But the thing is, because we've had no real attempt to do anything about inflation other than raising rates, inflation is not going away because inflation is not about the low rates. The Fed created inflation to make the rates low because it had to print money to buy all the bonds to suppress the rates. But what's really driving the process is government spending and the massive deficits that it produces that have no other means of financing other than inflation, the Fed. And we just raised the debt ceiling with no real cuts to government spending. The deficit is going to explode over the next 2 years, 4 or 5 trillion, maybe more. Inflation is going to get worse from here. It is not going to get better, despite the fact that the Fed has hiked rates. And in fact, those rate hikes are now working their way through the cost structure of business, just like higher wages or higher raw material costs or higher rents. And so ultimately, higher rates are just going to be part of the price increases that get passed on to consumers. And that's one of the reasons that the CPI in the future is going to be higher than it is now. Well, first of all, we have so much inflation in the pipeline because of 12 years of money printing, right? That's the inflation. The reason that the year-over-year numbers have come down is just because of the comparisons. We had such a huge increase in prices the prior year that on a year-over-year basis, at some point, you're always going to get a improvement because of the comparisons. The problem is going forward over the next year, you're not going to have those same comparisons. So it's going to be much easier later in 2023, early 2024, to have year-over-year numbers that are much worse. But if you look at the month-over-month numbers, just if you annualize each month in and of itself, we're still showing prices increasing over the prior month at an annualized rate of 5%, 6%, 7%. And this is cumulative. This is on top of the price increases that have already taken place. People were complaining about, prices went way up. Well, they keep going up. Prices aren't coming back down. We are not reversing any of the inflation from 2021, 2022. We're adding to it. And there is no path at all forward for inflation to come anywhere near 2% or stay there, right? Those days are long gone. CPI, unless they find a way to completely redo the index again so it can, hide the inflation to an even greater degree, we're looking at inflation at a minimum, probably 4, 5, 6% kind of trough, and then potentially much higher than that. So living in this world is very different from the world where inflation was below 2%, because you're in a whole new reality in that situation. And that requires, new interest rates, new gold price. But when the US government is confronted with an interest rate that reflects that higher level of inflation, it's impossible to finance. Even right now, interest rates are about consuming almost $1 trillion a year. We're close to $1 trillion a year in interest in the national debt. When you and I had that conversation that you're talking about, it was maybe 300 billion a year. Now you're talking $1 trillion. In a couple of years, if the Fed has to keep raising rates, let's say they get to 6 or 7%, but more and more of the short-term debt has a chance to roll over. Plus, we have to add to that all this new debt that we're going to borrow. In 2 or 3 years, it could be $2 trillion a year in interest on the national debt. Where is this money going to come from? The US government only collects about $4 trillion in taxes. How can 50% of tax revenue go to interest on the debt? Right? That's like somebody that earns $100,000 a year. They have to spend $50,000 a year paying the interest on their credit cards. You can't survive with that type of interest expense. So we are headed for a debt crisis, a sovereign debt crisis and a currency crisis. That's real. What we just went through
with the debt ceiling, that was fake.